Good morning, everybody, and welcome to the annual conference of the Wharton School's Levy Equity Management Center for Quantitative Financial Research. I'm Chris Geczy, Academic Director of the Center, and it's my pleasure to host today's event. Today, we'll examine the impact of the so-called Great Financial Crisis and crises and market volatility in general. We'll hear from an outstanding lineup of speakers representing diverse viewpoints. Nobel laureate Bob Shiller and Wharton's Jeremy Siegel will reignite their long-running debate on stock valuations for our keynote presentation. The slate of additional presenters, discussants, and panelists also include several former SEC officials and many notable speakers from academia and the financial industry. We're looking forward to hearing from them and learning from you as well, and I encourage all of you, as usual, to offer your questions and comments during the audience Q&A portions. If you'd like to access the slide presentations during today's event, please note that a link has been provided on the agenda page of the conference booklet, along with details on how to connect to it, and also to Wi-Fi. Exactly 10 years ago today, Lehman Brothers board capped a frantic weekend by voting to declare bankruptcy after Tim Geithner, president of the New York Fed, refused a government bailout. The next week would feature some of the most terrifying and then ongoing events in global finance since the 1929 market decline. Among other events, the failing Merrill Lynch arranged a fire sale to Bank of America. AIG did get a huge federal bailout, unlike Lehman. The reserve primary fund, along with other money market funds and other areas of repo, broke the buck, perhaps impacting global confidence in the entire money market fund universe. By the end of the week, Treasury Secretary Hank Paulson announced a plan for Washington to buy up more than $700 billion of illiquid mortgage-backed debt, the Troubled Asset Relief Program known as TARP. The increase in S&P 500 volatility, spot VIX, was a bit slower to manifest to its local apogee, but it was relentless nonetheless. The SIBO VIX index, one of a number, as we all well know, of reflections of environmental stress measuring implied volatility, opened the week of September 15th at 26, whereas its historical mean, or over the entire time period of his life, was about 19. At the end of the week, the VIX was at 32. But then the VIX rose further. 2 months later, on November 20th, it closed around 80. It pulled back at the end of the year to 40, but the next day the VIX would close below 30, was May 19th, 2009. 8 straight months of especially high implied volatility, reflecting ostensibly risk, which sometimes is best defined as more things can happen than will. Part of our agenda today is to examine how these events and the reality of high-risk settings are of import in quantitative financial research and asset management. We'll also examine how stock market valuations affect market returns and, of course, risk management itself. Our keynote speakers are possibly the two most fitting scholars imaginable to have this conversation, Bob Shiller and Jeremy Siegel, not to be obsequious in any way. With all of us aware how market events played out 10 and more years ago, and also aware today of investor nervousness at high stock valuations and other market valuations, a rising global interest rate environment, flattening of yield curves, and surging political uncertainty, our topics for today are clearly of deep interest to quant researchers, but are of course, of far more than academic interest. We're looking both backwards and forwards at events and risks existentially dangerous, not only to business, but to the whole global economy. Before we get started, I'd like to take the opportunity to thank Bruce Jacobs and Ken Levy, whose gift to Wharton starting in 2011 and whose ongoing partnership not only established the Jacobs-Levy Equity Management Center for Quantitative Financial Research and the Wharton Jacobs-Levy Prize for Quantitative Financial Innovation, but have helped our center thrive, which this is a wonderful testament to. The gift was made to commemorate the 25th anniversary of their firm, Jacobs-Levy Equity Management, which they co-founded in 1986. Since then, Bruce and Ken have played a major role in bringing quant investing to the forefront, publishing a series of significant articles in leading professional journals, co-authoring a number of well-regarded books, and generally supporting scholarship in finance. Bruce and Ken's gift to Wharton has helped ensure the school continues to lead in research and scholarship in the field of quantitative finance and quantitative research. To date, among a number of deeds, the Jacobs Levy Center has awarded 5 significant doctoral fellowships, more than 50 grants for faculty and student research projects. We have a working paper series that currently features more than 100 papers, and we award the Jacobs Levy Center research paper prizes to the most exceptional submissions each year. I look forward to recognizing recipients of the 2017 paper prizes later in the program, as you can see from the agenda. Today we are hosting our 6th large-scale conference or forum, and next year we will award the 4th Wharton Jacobs Levy Prize, which is given every 2 years. I'll add that the nominating period for the 2019 prize is open through September 30th, and I encourage you to visit the Jacobs Levy Center website to make a submission. They've already come in. The prize recognizes outstanding quantitative research that has contributed to a particular innovation in the practice of finance. And the next one will join a highly regarded and esteemed group of past participants, Harry Markowitz, Bill Sharp, and posthumously Stephen Ross. Many of you have seen Bruce and Ken's outstanding piece, co-authored with Frank Fabozzi, on Steve Ross in the special June issue of the Journal of Portfolio Management, which was dedicated to him in its totality. Or the piece also therein by David Musto, who presented at last year's conference, specifically on his experiences with Steve Ross. The issue is available at the IPR Journals table just outside the room if you'd like a copy. It's a great one, so please feel free to take it if you haven't seen it already. Speaking of which, I would also like to thank this year's conference sponsors, of whom we are sycophants, who may help make today's events possible. They are Institutional Portfolio Research Journals, Jacobs Levy Equity Management, and Wharton Research and Data Services, of which I think most in the room are familiar. If you haven't already, however, please do visit their tables outside the ballroom, which will be open throughout the day. We're also glad to have Sirius XM broadcasting from the conference for the 4th year. The show Behind the Markets, which happens to be hosted by Jeremy Siegel, along with Wharton alum Jeremy Schwartz of Wisdom Tree Investments, will be live on the air from 1 p.m. to 2 p.m. today. You can stop by and check out their setup near the registration area if you haven't done so as well. I would also like to thank the Jacobs Levy Center's corporate members who have made everyday progress and research support at the center along with the conference possible. AQR Capital Management, Kipos Capital, and McKinley Capital Management, thank you so much. Our membership program directly aids the research of Wharton and Penn faculty and associated faculty and students in quantitative finance. And we're most appreciative of the ongoing support of our members. In addition, these members enjoy certain benefits, including early access to research, involvement in center activities, and other advantages that I'd be more than delighted to talk to you about. If you're interested in learning more about corporate membership, information is included, and again, please come see me at your option. In addition, I would like to recognize this year's conference committee, Nick Rusineff from Wharton and Amir Yaron from Wharton, who along with I reviewed nearly 100 paper submissions for the conference. In addition, Bruce and Ken lended their efforts as well. They were all incredibly generous in helping craft the final program, and I thank them profusely for all their efforts to make this conference a success. Now, it's my great pleasure to introduce the Dean of the Wharton School, Geoffrey Garrett. Dean Garrett's connection with Wharton goes back more than 20 years to when he was a faculty member in the management department from 1995 to 1997. In addition to serving as dean, he currently is the Reliance Professor of Management and Private Enterprise, and a Professor of Management at Wharton, and a Professor of Political Science, more broadly, at Penn. Prior to his return at Penn, he was the Dean of the Business Schools at both the University of Sydney and UNSW in his native Australia. A highly cited international political economist, he's been on the faculties at Oxford, Stanford, and Yale. Keep going up. Dean Garrett is a respected commentator on global business, economics, and politics. And if you haven't already, I encourage you to follow his LinkedIn blog, where he regularly posts about a wide range of current topics. Please join me in welcoming Dean Geoff Garrett.
Good morning, everybody. It is my real pleasure as Dean of the Wharton School to be here to welcome you to this incredible and incredibly important conference. Since I'm Australian, I always have to start with a self-deprecating remark. which in this context is heartfelt. I really only have two important things to do. The first is to signal by my presence and maybe with a few words just how important this center and this conference is to the Wharton School. But then the second one is for me just to get out of the way, because you want to hear from people who have world-leading expertise on topics that are important to you. As Chris was just saying, I'm a political scientist by training, and I tend to look at things from the outside in, not the inside out. And when I think about that, I was just saying to Bruce that if you think about the last 20 years, it's clear that the two most important days in those 18 years, the new millennium, for the United States and for the world were September the 11th and September the 15th, the fall of Lehman Brothers. Two events with global ramifications that spread instantaneously, but also of long-lasting impact on our world. So the fact that they're both in the same week makes this, I think, for everyone, a very intense week, of course, particularly in New York. When the crisis hit, the Lehman Brothers weekend, I was actually in Sydney, Australia, and it was quite amazing. The Australian banks, some of you may know, Australian banks are very well regulated, tightly regulated. The financial markets are pretty protected. And unlike European banks, Australian banks weren't very heavily invested on Wall Street. Even so, Australian credit markets froze instantaneously after the Lehman weekend. And of course, that was just one example of what metastasized globally almost instantaneously. The other thing that happened in Australia, and of course it made sense to happen in the US, but it happened in the UK and in China, right? Countries that are far-flung, very different financial systems from ours, was the immediacy of unprecedented government action in response. The TARP bill, the first TARP bill that Secretary Paulson presented, I think was one page, asking for $700 billion. Interest rates went to near zero instantaneously, and then we had to come up with quantitative easing, not only once, not twice, but 3 times. The Australian fiscal stimulus, again, halfway around the world, was about as big as that in the US. The Chinese fiscal stimulus was larger. All of those things happened because of the financial crisis. It was a really big event. It was an instantaneous event. This week, of course, we're all reading requiems on the financial crisis. And some of them are about sort of what happened that weekend. Did the government make a mistake in not bailing out Lehman Brothers? Maybe if you'd done that, it wouldn't have been so expensive to do AIG a little bit later. Questions like that. And then there was maybe a Bob Schiller kind of question. What did we know about markets at the time? Were markets irrationally exuberant? Were they naive? Were they arrogant? Were they obstreperous? There are different ways we could think about what was happening in markets at the time, and clearly that requiem move is important. Then there are lots of other moves that are being made today. There's one that says global financial crisis, deep recession, stagnant incomes, populism, the election of Donald Trump. I've seen a lot of stories like that. Other stories contrasting the incredibly coordinated government action after the financial crisis, where the G20 went from being irrelevant to being the central actor on the global stage almost overnight, with a period 10 years later where we get no global action on any of the economic issues, and everything is being done independently in different economies, and in fact we're building barriers, not building bridges. Other big picture perspectives, obviously what do we think about Dodd-Frank, and what did it do to the structure of the industry, et cetera? So there are lots of questions, but I'm so pleased that this conference is going to focus on the core competence of this center, and clearly, by the evidence of all the people in the room, something that really matters to you. And I know it's very close to Bruce Jacobs' heart. Bruce has a new book coming out. And I was just saying to Bruce that, yes, you want to do backward-looking analysis on what happened, but the most important reason to do that is because you can leverage it to make things better in the future. And I think it's that forward-lookingness of this event Balancing perspectives from the past with forward-lookingness that is uniquely positive about what you're all going to experience today. At Wharton, as you know, Wharton's long been viewed as the finance school. That's a fantastic thing for us. Having that global brand is incredible. But what I notice about everybody associated with the Wharton School in finance, not only our fantastic faculty and students today, but our incredible alums, I'm sure there are many of you in the room, is that you don't want to rest on your laurels. It's not a backward-looking thing. It's not just to celebrate the history of finance at Wharton. It's to leverage that history to do better things today and tomorrow. And that's what this conference is about. I couldn't be more pleased to be here for that reason, but then I have to just end with my one sincere regret. The job of the dean could be subtitled The Tyranny of the Calendar. And my calendar says that I have to be back to speak in an event on campus at lunchtime. So I don't get to listen to Bob Schiller and Jeremy Siegel. My loss, not your loss at all, it's my loss entirely. I can't stay for that, but I know that you're in for a special treat. And I think, as Chris alluded to, the pairing of personalities as well as perspectives here is just a close to unique one and a uniquely great one. So I am going to exit the stage now, but my last formal responsibility is to hand the stage over to my friend Bruce Jacobs. Bruce and Ken, what they have done for the Wharton School, what they continue to do for the Wharton School is just incredible. And we are continually, and I personally am in their debt, but I also want to thank them for their incredible partnership and support of me and the school. It's a real pleasure for me. So again, on behalf of the Wharton School, welcome to this great event. Please join me in welcoming Bruce Jacobs.
Thank you, Chris, and thank you, Jeff, for your very kind comments. Good morning to everyone. Welcome to the 2018 annual conference of the Jacobs-Levy Equity Management Center for Quantitative Financial Research. As Chris mentioned, Ken Levy and I established the center in 2011 to honor our firm's 25th anniversary. Our goal was to spur idea creation and innovation that makes a real impact on the practice of finance. Tomorrow marks the 10th anniversary of Lehman Brothers filing on September 15th, 2008. The global financial crisis that followed is still a fresh memory for many of us. The good news is that we are still standing. The bad news is that there's still much we don't know about what causes these crises. And we don't know whether the next major crisis, and there will inevitably be one, will look like previous crises or like something entirely different. Fortunately, we'll hear today from a number of scholars and experts who can at least draw on the outlines of the next crisis by identifying some telltale signs and areas of concern. The more we can learn about the origins of financial crises, the better prepared we'll be to respond to them, or even better, to head them off. Richard Evans will start us off by exploring one of the lesser-known risks of exchange-traded funds, their outsized role in failed short sale transactions. Richard identifies a key cause of these failures as operational shorting. Such shorting may create counterparty risk with potentially destabilizing effects on the markets for ETFs and their underlying securities. Adam Reed will discuss Richard's findings. Our keynote address features, as has been mentioned, two distinguished speakers, Nobel laureate Robert Shiller of Yale and Jeremy Siegel of Wharton. The debate is entitled, "Are Stocks Too High? A Historical Perspective." After the lunch break, we'll present the 2017 Jacobs-Levy Center Research Paper Prizes. A panel discussion will follow on the impact of financial crises, past, present, and future. I'll be joined by Veneer Bhansali and former SEC directors and chief economists Richard Lindsay and Chester Spatt. Richard Herring, or Dick Herring, will moderate the discussion. Next, Kathleen Hanley explains how large sets of data from investors and banks can yield clues to emerging risks in the financial sector. The approach she outlines uses computational linguistics to identify sources of emerging risks and instability. Paul Glasserman will be the discussant. Lastly, Robin Greenwood examines the claim of Nobel laureate Jean Fama that security prices do not exhibit bubbles. He finds that sharp price increases, whether they're called bubbles or not, do predict a heightened probability of a crash. Past price run-ups that were followed by crashes have exhibited certain characteristics that may help predict future returns. Matt Richardson will comment on the paper. It's been said, those who don't learn from history are doomed to repeat it. Hopefully, after today's discussions, we'll be the better for it. Ken and I look forward to meeting as many of you as we can. Thank you.